So this is my first video and the first video has to be introduction, right? So today we'll be talking about finance and when we usually hear finance, things like a lot of money, a lot of maybe calculations, a lot of graphs, a lot of statements, a lot of numbers comes in mind, right? And yes, it is true. In finance, we make a lot of decisions regarding money, where to invest, how to get the money, sources of finance, etc. We calculate our profits, our cost, everything. We use graph to see the future trends, where the profit would be going the next year, maybe the trends of the next year. And we use statements to just crunch down numbers of what would be the revenue, the expenditures, the income that we'll be getting, the cash flows, etc., everything, right? So yes, this is true, but this is what we actually do in finance. But when you ask me what finance is, I believe that finance is something that helps us in making smart money decisions. Now, how finance helps in making smart money related decisions, right? So in this video, as well as all the other videos that would be coming, I'll try to talk about finance and its concepts through a medium of storytelling, right? So let's start with the story, right? So let's say there's a person, let's name him Raj for this video, right? Now Raj has a tea stall, right? So he has a stable income, a lot of customers come to him and buy his tea. Now he's thinking about expanding his business, right? So he has a stable customer base, right, who regularly comes to him. So what he decided is that let's buy a grill machine, right? Because people are coming having tea, maybe they could want a sandwich or anything else. So he just wanted to expand his business. So he basically decides to invest in a griller, right? So now this griller costs something, right? Let's, for this example, imagine that this griller costs 10,000 rupees. Now what he said that, okay, so I'm investing 10,000 rupees in that, right? How would it benefit me? Let's say he calculates that he'll be able to get around 500 per day more if he invests in a griller, right? So what we can do is, let's write 10,000, that's the cost of the griller, and he'll be able to earn 500 per day, right? At this pace, in 20 days he'll be able to cover back the investment. For now, let's ignore all the variable costs, maybe the bread, maybe the vegetables, everything. Let's just concentrate on the revenue and the 10,000 that he'll be able to cover, right? So this 20 days, so in finance, this 20 days, this period of 20 days is called payback period. This is called a payback period. And 20 days, it's not a a large number of days, right? So in 20 days he'll be able to cover the investment, and he thinks that it's a pretty good deal, right? So he went ahead and he decided to invest in a griller. Now the second thing comes, where to get the money for buying the griller, right? Now let's say he has two options. First, let's say he has an FD of rupees 10,000, in which he's getting an interest of let's say 5% per annum, right? In the second option, let's say he approaches to a bank and he gets a loan for 10,000, and that could be for around 10% per annum, right? Now he did some calculations and he find out that in FD he's only getting 500 per year, right? And if he took a loan out, he'll have to pay 1,000 rupees per year, right? Now what is a better thing to do? of course he has an FD, he's actually saving 500 rupees, right? So what he'll do is he went ahead and he broke his FD and he bought a griller. Now what is this decision, what is this calculation? What he did was he compared the interest of the two options that he had, right? So basically he was trying to find out what are the sources of funds, right? The FD or the bank loan, right? Now this particular decision, this is called a financing decision. How he'll be able to finance the purchase of this griller? So this is basically a financing decision, right? Now let's just move ahead. Now what he thought is, like, let's say his griller was a hit. Now he's attracting even more customers who are just there to have sandwiches, right? Now let's say some of those customers are willing to have coffee with the sandwiches rather than tea. So he found out, and let's say he is able to get a second hand coffee machine, let's say for 5,000 rupees, right? Now what happened here is he was able to earn 500 rupees extra from that griller, right? Now just we'll do some calculations here. Let's say the extra money that came from 500 is the extra money that came from the griller. Let's say excluding all the variable cost, he'll able to earn 215 profits, pure profits, right? Now again he's earning more profit day by day, but his expenses maybe are his expenses is only increased by, let's say, rupees 50, right? He has an extra 200 rupees which are just sitting there in the bank, or it's just with him, right? Now what he can do is he can purchase this coffee machine for 5,000 rupees, and again he'll make a decision. No interest has to be paid in this 5,000 rupees. No let's say bank loan has to be taken for this 5,000 rupees, because he has an extra 200 rupees lying with him. Let's say with this 200 extra, within 25 days he'll be able to cover the cost of this coffee machine, right? Now let's have a look at this figure. What is this 50 rupees and what is this 200 rupees? Now in this case, 50 rupees, this 50 rupees would be called a payout, right? And this 200 rupees would be called reinvest. We'll reinvest this money, this 200 rupees, and we'll reinvest it in buying a coffee machine, right? So this money is utilized for reinvesting the 200 rupees, and 50 rupees is for his consumption, right? Now this particular decision of utilizing 250 rupees, this is called a dividend decisions, right? So basically these are the three major financial decisions. The first one here, when we talked about investing, this was an investing decision. Investing in a grill machine, even investing in this coffee machine is an investing decision. This here, this is a financing decision, as well as this, how to financing it by reinvesting. This reinvestment funds could also be called as retained earnings, right? He has retained this 200 rupees in his business rather than using it for his consumption, right? So these are basically the three major financial decisions. The investment, what to invest, where to invest. This could this decision could be taken by utilizing the payback period, right? The financing decision, this could be done by utilizing the opportunity cost. He is actually sacrificing 500 rupees per year because he'll be able to cover the loss of the 500 here in 20 days, right? And the dividend decision, he's able to maintain a ratio that how much to retain and reinvest in the business and how much he can actually afford to use for its expenses, that is payout, right? Now where are and how are these concepts applied, right? So these concepts are applied in basically three things: personal finance, corporate finance, and public finance. Now let's understand this. Now, personal finance. Personal finance is basically whatever calculations or whatever ideology of using financial tools you undertake to make a sound decision. Now, preferring FD over a bank loan. This is a good example of personal finance, right? We are looking into a business, but even let's say it was for a car. Now, let's say he's, for example, let's just assume that he can buy a car for 10,000 rupees and he has an FD, plus he has a bank loan, the option of having a bank loan, right? So, in when we're talking about buying a car for its personal use, this is called a personal finance, right? So we can categorize this as personal finance, right? So this is how it is used. Now the next one is corporate finance. Now what big companies do is they try to invest in new ventures, right? Maybe expand their business. They have to make decisions that if that investment would be fruitful or not, right? So here we can have a snapshot or a quick look of investing. He's further investing in his business, trying to grow that business. So growth, right? This is what corporate do. And corporate what also does is finding the best source of money, right? Maybe they can have retained earnings, maybe they can opt for debt, right? So this is how finance helps corporates making sound decisions, that is smart money decisions. Now let's talk about public finance. Now public finance is basically related to the government, right? What government does, right? So when we are talking about government with a financial perspective, let's talk about the inflows and outflows of government, right? The inflows and outflows of government. So inflows and outflows of what? Of course cash, right? So when we talk about inflows of cash for government, that would be the tax, right? Or TA. That's an economic term. TA, right? And when we talk about outflows, there are two things. One would be welfare programs, another could be infrastructure. The government could actually launch few welfare programs which are actually sponsored by the taxes that we pay, and also it could invest in infra. Like talking about welfare programs are basically it could include transfer payments, let's say, right? What are transfer payments? Again, an economic term. Now transfer payments are basically let's say for example pension is a transfer payment. Now why pension is a transfer payment is because senior citizen gets pension, right? So government is paying money to senior citizen without expecting anything in return. They are not making senior citizens work for that money, right? Of course they earlier did for that money, but now they are not expecting anything in return. So this is a welfare program and that's called a transfer payments. Now infrastructure could be making roads, making parks, right? Installing street lights, right? So government has to take sound decisions of what should be the ratio of welfare programs as well as investing in infrastructure, building roads, building parks, installing street lights. Everything is important, so there needs to be decision that has to be made. So how to make the decision? Let's say for example let's say this is a city and these are basically the roads, right? Let's say this is a park, right? And these are all the roads, right? Now let's say government realize that they can either spend 10,000 rupees on a park or they can install street lights throughout the city for 10,000 rupees. Now what government will do, that it will realize where are the general public benefiting the most. Let's say the park is at a remote area in the city, right? So let's say for example only 150 people would be able to benefit from the park, of course, right? Now if on the other hand they are installing street lights, how many people would be able to take benefit from that? Let's say around 10,000, right? Everybody is using roads, right? So investing 10,000 rupees for a park and only benefiting 150 people, and on the other hand we can invest 10,000 in street lights and benefit 10,000 people, right? So which one is the better way to go? Of course the street light. So again, finance helps in making sound money decisions, right? So this is basically what the concept is, and how finance in daily life helps in making uh, maybe easy, maybe tough financial decisions, and maybe smart money decisions, right? Thank you.